This is Matthew Cratter from Trader University, and today I want to answer the question, is Bitcoin too expensive? I often get these kind of comments on my YouTube videos. Bitcoin's at 38,000, XRP's at 94 cents, and so Bitcoin is really expensive while XRP is cheap. Also comments like nobody will buy Bitcoin when it hits $100,000 because it'll be too expensive, and thus the price cannot go up from there. Now this is a common beginner's mistake, and people make it with stocks and they make it with cryptocurrencies. This was a mistake that I made early on as well. The technical name for it is unit bias, where people would rather buy a whole share of stock rather than a fractional share of stock, now that that's possible, and people would rather buy a whole XRP, for example, a whole unit of a cryptocurrency rather than a fraction of a Bitcoin. With Bitcoin at 38,000 now, most people are forced to buy a fraction of a Bitcoin. And this really drives a lot of people into looking into other cryptocurrencies like Cardano or Dogecoin or XRP. But this is a mistake, thinking that low-price stocks or low-price cryptocurrencies are cheap and that high-price stocks or high-price cryptocurrencies like Bitcoin are expensive. This is something that penny stock promoters use to their advantage, and also altcoin peddlers like Ripple Labs, which is the corporation that is behind XRP. And this is really the genius of Ripple Labs. They are a bunch of scammers. They're being sued by the SEC finally, fortunately. But their genius really was to issue so much XRP that the price of each one was very low. So the max supply of XRP is 100 billion. And as a result, there are only 21 million Bitcoin, there are 100 billion XRP. And even if they had the same market cap, the value of a single unit of XRP would be much smaller. So XRP trades for 93 cents. This looks really affordable. And then people go back and say, well, what happens if XRP goes to $2? Or what if it goes to Bitcoin's price, which is $38,000? Think of how much money you will make. The problem with this is that it again confuses the price of a unit with the valuation of the whole thing, which we're going to talk about later in this video. The other problem, of course, is that there's a huge overhang of XRP. It's locked up in escrow. It's periodically dumped on naive retail investors. But out of that 100 billion XRP supply, only 46 billion has been released and is circulating. And so less than half of the XRP is out there circulating. This is very similar to what you get with an IPO stock before the lockup. What a company does, they issue a small percentage of their shares at the beginning, then they can pump the stock high up, and then the rest of the shares are unlocked after 180 days. And you have this huge flood of sellers. This is one reason that XRP has so much trouble going up, because there's this huge supply that everyone knows will be hitting the market at some point. Bitcoin, by contrast, 89% of all the Bitcoin have been mined and issued and are circulating or are being hodled in cold storage by Bitcoiners. If you're finding this video helpful so far, or if you'd like to see my video on Ripple XRP, I'll link to this below. If you're enjoying the current video, hit that subscribe button and that like button and share it with a friend who's into Dogecoin or XRP or one of these garbage currencies where they're really going to end up getting hurt if they don't figure this out sooner rather than later. One thing I should mention is that institutional investors, who obviously control the bulk of the money and can have a very big impact on whether stocks go up or whether cryptocurrencies go up, these investors usually actually prefer higher priced stocks and higher priced cryptocurrencies. It really depends whether you're paying. The traditional model for buying stocks is you pay a certain amount per share as an institutional investor. I'm not really sure where that is now. It's probably around a penny or so, depending on what deal you have. But if you have a $10 million to deploy, you're running a $100 million hedge fund, you want to put 10% in a stock, and your per share commissions are a penny per share, you'll actually prefer higher price stocks, all else being equal, simply because you pay less in commissions. If you're paying a percentage commission, then it doesn't really matter. But institutional investors have no bias against higher price stocks For this reason, and also because they don't invest based on the price of the stock, they invest based on the valuation or where they think the valuation is going. And they have various valuation models that involve free cash flow or revenue growth rates or PEs or adoption rates, etc. Also, institutional investors think in terms of market cap. With a stock or a cryptocurrency market cap, you can think of the market cap as being the whole pumpkin pie. The number of shares or the number of units of cryptocurrency is basically just the number of slices of that pie. And so to calculate the market cap, you just take the number of slices of pie or the number of units, multiply it by the price of each slice of pie or each unit or each cryptocurrency unit or each stock, and then you end up with the market cap, which tells you the total value. Again, this can be a little bit misleading because if you have a huge supply that's sitting on the sidelines, this is why CoinMarketCap calculates fully diluted market cap, and then I think they do liquid market cap. Either way, institutional investors think in terms of market cap and the number of total and the valuation as well. If we compare the market cap, for example, Bitcoin and other cryptocurrencies, these are not really comparable, but Bitcoin currently at about 700 billion, XRP at 43 billion. But again, that is it's a little bit misleading because you have different percentages of circulating supply. But this is one thing to keep an eye on, the relative market caps of cryptocurrencies, Ethereum versus Cardano versus XRP versus Bitcoin. And rather than looking at the unit price and falling victim to unit bias, we look at the market cap. High prices certainly haven't hurt stocks in the stock market. If you've been doing this for a while, you've learned that higher price stocks tend to trend better, they make better momentum stocks, and they can often be better investments as well. People who say that Bitcoin can never go past 100,000 because that's a lot of money, quote unquote, a lot of money, they forget about stocks like Berkshire Hathaway, which the A share is currently trading at $432,000 for just one share of the company. So again, what matters is the total market cap of the company and the valuation. It doesn't really matter how many slices you slice that pie into. Amazon is another example of a high price stock that has done very well. They've only done a couple, maybe 3 splits over the lifetime, and one share is quite expensive for the average retail investor. That being said, you can buy fractional shares, etc., and it's not really a question of the price of the stock, the price of each unit. What matters is Amazon's forward growth trajectory, its current market cap, its earnings or free cash flow or revenue compared to the current market cap. By contrast, you'll have companies like Reeds, for example. This is a penny stock, trades for less than $1. REED is the ticker. You can see that these tend to be much more mean reverting. They tend to not go anywhere. And they really do suck in a lot of new investors, unfortunately. I was reminded of this quote by Oscar Wilde that a cynic is someone who knows the price of everything and the value of nothing. I would substitute and say a beginner trader or investor, someone who knows the price of everything and the value of nothing. So I'd encourage you, don't look at the unit price. You need to have a valuation model. You need to be looking at the market cap as well. So one way of valuing stocks, for example, a very traditional way, is to look at the PE ratio, which is just the price per share divided by the earnings per share, or the market cap divided by the total earnings for the company. We can see Berkshire Hathaway right now it's a very high price stock, as we said, $432,000 per share. That being said, it has each one of those shares currently earns $66,000, or at least it did over the past 12 months. That's why it says TTM here. This actually is a fairly low PE ratio. It's a little bit skewed because Berkshire does function in many ways like a financial company. Normally, you don't want stocks that have quite this cheap of a PE. But the general point here is that when you look at unit price, you always have to compare it to your valuation model. And in this case, you might want to use earnings, which themselves are very high. And this is one reason that the stock price is very high. It looks like Berkshire right now has a market cap roughly comparable to Bitcoin. And it can be a mistake to compare these things simply because one is a cash generating asset, which is Berkshire Hathaway, and Bitcoin is much more like gold. It does not naturally produce a cash flow unless, of course, you lend it out. So Berkshire Hathaway has a valuation or PE ratio of approximately 6.5. If we look at Reeds, this is actually not. I don't know anything about this company. I picked it randomly, but it does have some fairly disturbing history. In the last 12 months, it lost 17 cents per share. It's currently at 92 cents per share. And if it keeps doing this, you could apply just a very simple math and say this stock is going to go down 17 cents a year. That's probably not exactly accurate, but this is Reeds looks like it looks like a sinking ship, and that's destroying value over time. And so even though the unit price is very low, you have to think in terms of valuation models. And it doesn't even have a PE, because when you have negative earnings or earnings of zero, you cannot have a PE. In this case, it would have a negative PE, which wouldn't really make any sense. So when we're looking at Bitcoin or looking at XRP or any other cryptocurrency, there are various models that one can use. XRP is a scam. It's being investigated by the SEC. And so I think that's the most salient fact in terms of valuing that currency. There are other metrics you can use, like the growth of the growth rate of the network, etc. But I'll give you a valuation example for Bitcoin, which is the only cryptocurrency I'm currently investing in. Market cap of gold, physical gold, yellow shiny rocks, is $10 trillion. Currently, market cap of Bitcoin is $700 billion. And so if Bitcoin is gold 2.0, if it's digital gold, this is one valuation model. We would say over time, we would expect Bitcoin to steal market share from gold and somewhat approach its market cap. And so the market cap of Bitcoin should be approximately 10 trillion. This is how gold has functioned as a store of value, and this is how much capital has been allocated to it in that function. And so we could say, using this valuation model, that the market cap, and by extension, the price per Bitcoin should be 14x higher. And so that gets us well beyond. I think I would say it's close to $500,000 per Bitcoin. So that would be one model. If you've been watching my channel for a while, you know that I've been following the stock to flow model very closely. This was put out by Plan B, and I'll link to this chart here. But you basically have this kind of red line, this red or brown line that I'm touching right here. That is the model price, the valuation price, and then you have the monthly prices of Bitcoin, which are these various colored dots. And we can see that Bitcoin's price, the actual price, has tracked the model fairly closely. In fact, remarkably closely. Now, sometimes it trades above the model price. Sometimes it trades below the model price. We can see down here that when this line is green, that shows that it's trading at a discount to the actual model price. And it looks like we've fallen off quite a bit. This is where we are right here. Comparable things happened in the previous run-up of 2017. We can see over here that the price of Bitcoin for much of the run was below the model price. This model price, this particular Plan B model, has Bitcoin going to 100,000 certainly by next year, and then by after the 2024 halving, has Bitcoin going to 1 million. Plan B has a similar model that is looks at different assets. It's the cross asset stock to flow model, and that model has Bitcoin going to $288,000 in the current cycle. So by the end of this year or early next year. And so when you're evaluating cryptocurrencies, you need to have some fundamental framework. Maybe you trade them using momentum, but if you want to value them and have an idea of where they're going long term, it very much helps to have a valuation model and not be confined to thinking about the unit price. There's been a lot of talk about, so I should say that one Bitcoin is divisible into 100 million units called Satoshis, named after the inventor of Bitcoin, Satoshi Nakamoto. These are often called sats for short. And as such, anyone can buy Bitcoin. You don't need to buy a full Bitcoin. You could buy a fraction of a Bitcoin. Some people have suggested renaming Satoshis into bits, so you would have Bitcoin and then bits, which I think is very clever. The Bitcoin community is fairly conservative in the sense of not wanting to change things too much, so I'm not sure if this will happen, and I'm not sure if I even think it's a good idea. But I do think that either way, the high price of Bitcoin, the high unit price of Bitcoin is not a problem. Eventually, even retail investors will start to think in terms of sats. And certainly if you look at the Bitcoin price right now in terms of Satoshis, it's very, very low. It's less than much less than a penny. And I think that in retrospect, Bitcoin probably would have had more institutional appeal if there had been more, if the way the units had been divided up, the way the pie had been divided up, created much smaller units, because people do get sticker shock when they see something cost $38,000 when you have 1 unit of the currency that basically you can buy a car for the same price, or half of a car for the same price. So I think this does sometimes confuse retail investors. That being said, the high price will not affect its subsequent rise. The high price of Berkshire Hathaway stock has certainly not hurt it. The high price of Apple and Tesla before their splits, the high price of Amazon, which hasn't done a split in a while, has not been an impediment to their stocks going up a lot. And as such, I'm still following the stock to flow models. My target for Bitcoin at the end of this year is still at $200,000, which I think it will easily achieve. But it's very important not to get confused by unit bias, as many new investors in stocks and in cryptocurrencies do. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.